Hi, I guess it's the time of the year again where companies essentially go through this quarterly exercise where they come in front of shareholders and present the report card and essentially face the music, especially for management team that failed to deliver. So I think specifically for my channel and for many of you who actually subscribe to me and actually watch every single video, most of you are Alibaba bag holders or shareholders if that makes you a little bit more comfortable. Anyhow, of course, I couldn't miss this earnings report because it's essentially Alibaba wrapping up their 2023 financial year. So it's a little bit more special because they end their financial year reporting in the March of every single year. So in this case, just some quick updates as well. I know I've been a little bit late, especially in this YouTube game because every single one of them, Alibaba reported last Thursday. I think most of the reports or most of the analysis are out on YouTube by Friday or by the weekends. And here I am, only coming in the middle of the next week. So I do seek for your forgiveness here. So I kind of just ended my exams. Actually, it's my last semester in university, around 2.5 weeks back. And I took a 2 weeks break. I actually traveled to Taiwan and Hong Kong. And then here I am back, probably more energized, more enthusiastic, and more passionate to talk about the stock market. Because like I did mention or allude in a few of my other videos, I'm pretty passionate in what I'm doing, which explains why I'm still here after a good 2 years, I guess. But anyhow, I do believe that there are some exciting things coming up for me, for this channel. I'll probably still stay active here, and if time permits, of course, I would like to provide some updates and some of my sharings and learnings over the years in the stock market as well. And of course, for those of you who have, as always, like the video and like my type of content, remember to smash that cute little like button and also subscribe on your way out. Anyhow, I think to just really provide some perspective on this Alibaba earnings report. So in terms of numbers wise, I believe many of you out there who actually decide to actively pick stocks, you guys know how to monitor numbers, how to look at the companies, what are the margins, etc, etc. So I would like to take a different approach here in this specific video. So let me just try to start off by telling you the story that have transpired over Alibaba in the last 3 years or so. So I've actually got the financial data for the last 4 years in this Excel sheet. So that it's nothing new. It's not any projection or postulation for Alibaba in the future. It's actually all backward-looking data. So I think I just wanted to paint this narrative and to really allow you to appreciate more in terms of the context of Alibaba. So this is back in 2019. So you can see those are the dates. And before this new breaking out of the company and how they want to break down the revenue in more granular details, actually Alibaba only have a few main parts, which is the core commerce and the cloud business. So let's exclude digital media and innovation because those two are profit losing. They aren't really very substantial to the overall revenue mix, and essentially they don't bring in any earnings at all. So the growth rates are essentially color coded, and the different shades of green just means how good or how bad it is. So in this case, you can see that back in 2019, so let's go year by year. So back in 2019, you can see that growth of Alibaba is just incredible. Look at it, 20%, 40%, 30%, 20%. And we are talking about the core commerce business here, just focusing on column B. So core commerce business on a year-on-year growth rate, 44, 39, 37, 19%. And even on a consolidated basis, it's 42, 39, 37, 22%. So none of the investors out there or none of the bears of Alibaba will complain, or none of the bears of Alibaba will argue that, oh, Alibaba is not a growth company. In fact, Alibaba was priced as a growth company back in 2019 and 2020. So this is all before the entire tech crackdown, rug pull of an IPO, etc. So moving on to 2022, I think it's the similar case. Honestly, you can see in column K, 33%, 29%, 38%, and on a consolidated basis, 33%, 30%, 36%. So if a company is able to consistently grow 20 to 30%, I believe many of you would agree that it's a growth company. And of course, the valuations do reflect this sort of optimism and enthusiasm from the stock market as well. So back then, I think Alibaba was trading over the $200, $250, $300 range. And even so, if you were to translate down to bottom line, looking at the operating margins, they tell a similar story. It's a tech company by and large. 20%, 17%, 20%. Of course, but there are some faltering here and there. There's 6%, there's 4%, there's 8%. So in this case, let's not look too much into it. But I think overall, we can all agree that in 2019 and 2020, Alibaba's story was intact, it was perfect. It was the next growth company, it was investing in China's next big story, which also explains why Alibaba was commanding around a $800 billion plus valuation. So I'm not sure if you've heard of this quote before, but I do believe that the best time to invest was yesterday, and the next best time is actually today. So although that the overall markets may still be slightly down compared to its all-time highs, but if you're to stretch out over a long time horizon, many brands that you use on a daily basis has seen an incredible amount of gains. And you should invest and also grow with your favorite brands, starting today with Momo Singapore. So some common brands that many people use includes Amazon, which saw a gain of 43% from 2018 to 2022. And Starbucks was up 89% in the same past 5 years. And guess what? Microsoft is up a whooping 195% over that same time period. So with that said, I would still like to remind all of you that investments do carry risk, and past performance definitely don't guarantee future results. So for those of you who have yet to open an account with Momo, they have an amazing promotion reward campaign, and you can get rewards worth up to 208 Singapore dollars. So all the promotion details will be down in the description below. So don't let this sweet deal get away so easily. And for existing users that currently have an account with Momo, don't miss out this opportunity to get some cash coupons. So just make sure you click on the link below. A big shout out to Momo for sponsoring this video. So then after that, you can see there is this red color note that I've written down there. There's this antitrust negative 18 billion, which explains why their operating income went to the negative. So right after 2020, Alibaba's story began essentially faltering and falling flat on its face. So in 2021, it's also the first year where they essentially tried to break it down into more granular details. So when you scroll down, you can see that there's even more breakdown. So I essentially still broke it down. This is copied from their annual report. And then I tried to still combine them together to really just have a very broad-based picture and to understand the picture and on a much more, I guess in a more comparable way, because if you were to compare it to the last 2 years, the last 2 years only had this similar breakdown. So I kept the same function, so core commerce, cloud, and then the other two. But the core commerce now is broken into a few more granular details. So China commerce, international commerce, local consumer services, Cainiao, and then cloud, digital media, blah, blah, blah. So in this case, you can see that in 2021, that's when the tech crackdown, the effects of the government regulation and intervention, it really start hitting the entire company. And of course, to add on, there's competitive pressures and the up and rising of ByteDance and TikTok and stuff like that, which also explains why numbers started falling flat on its face. You can see that growth rates in the earlier part of 2021 or even until 2021, they are still growing at a decent pace. And then right after, you can see it dropped. It started dropping. The core commerce segment started dropping. So going into 2022, it's the same story. So everything started dropping. Negative 3%, 2%, 2%, which also explains why I think investors are starting to get shaken. But also, I would just like to kind of point out that, hey, there are many things or there are many moving parts in Alibaba's business. And I think cloud was also one of the main contributing factor, because you see that in the cloud business, it was growing 50-60%. And then because of many other myriad of different factors, cloud started slowing down 10%. And even in the latest quarter, it's actually down 1 to 2%. So this is essentially the general gist and the general picture of what's happening or transpiring with Alibaba in real time. And a lot of people like to say, I guess the stock market might be irrational in the short term, and it's a voting machine in the short term. But I think the interesting thing is, because of this front running of the price target, you can see that fundamentals essentially, or at least based on some of these operating metrics, it does reflect some sort of deterioration in fundamentals and economic mode, if I may say so, even as a very big Alibaba bull. But then at the end of the day, why am I still holding on to a stock that evidently there are signs of fundamentals decreasing? I think I'll try to explain it, or at least I've been trying to explain my position over the last 2 years. And I've also kind of realized that the more you explain, the more embedded you get, the more you get convinced by your own argument. And I think it's pretty unhealthy. So let's just take an objective look at this recent earnings report and to just provide you with some perspective on why I still kind of hold Alibaba. And one important factor, of course, is this entire idea of valuations. So a lot of people like to complain that, even though Alibaba is cheap, look at it, the economics or the mode is deteriorating, the fundamentals are no longer existent, blah, blah, blah. So yes, we can go on to argue until the cows come home. But if I guess only time will tell whether who's on the right side of the curve. But let's just first look into this latest earnings quarter, hoping that the story of Alibaba, or how, or if you were to superimpose the entire curve or the entire price chart of Alibaba, you can kind of see the expectations or market expectations of the stock itself. So now, just jumping into the entire results, I'm not going to spend too much time delving into individual numbers. I'm just going to pick the ones that I think are important, because it's I mean, my video is a little bit late. I think there are many fantastic analysis out there speaking about going through every single line item, but I'm just going to pick the more important ones. So this is essentially just a snapshot of the company in the quarter and also the year ended 2023. So essentially, I think there are two main disappointments. It's the China commerce and the cloud business. I think for the rest of the business arms like international commerce, local consumer services, and Cainiao, they've been executing on all fronts and they're firing on all cylinders. So they're still growing at 10, 15, 18, 17, 29%. I think those are decent growth, to be very, very honest. And they've also kind of reached a certain scale. So they're not some small innovation arm that just came out. They've been there for quite some time. And yeah, it's debatable on the international commerce business itself, whether Lazada is able to win Shopee, but that's another topic for another day. But anyhow, I think I just want to focus on the two main ones, which is China commerce and cloud in this case. But before that, I think just some general gist or general guidelines. Alibaba has been talking about cost controls, efficiencies, trying to improve their cost structure, and it's evident in the numbers. They are reducing costs. They're trying to optimize a lot of the cost structure and stuff, which is why their net income, I mean their EBITDA across many of the business segments have been improving, and margins are also starting to expand. So back to this Excel, you can see that at least based in 2021, you can see operating margins, they're abysmal for a tech company at least. 15%, 7%, 2%, 8%. And then when we come to 2022, you can see there's some sort of normalizing and just really adjusting upwards. So they are going back to the teens and at least in the mid-teens. So 12, 14, and then 7%. So that's at least some sort of commitment, or at least from Alibaba's perspective, they say that they're going to be more efficient, and it's showing in the numbers. So I'll give credit where credit is due. And more importantly, if you were to look at the balance sheet of Alibaba, I can't emphasize enough, this company is not going to go bankrupt. So unless they're cooking the numbers, or like many of you like to believe in China, you can't believe their numbers. If not, in terms of the cash balance, their net cash position is currently at 58 billion, even though they only have a market cap of, let's say, 200 billion. So yeah, a quarter of their business, the value of the business is the net cash position. And one more important fact is the cash flow. So the idea of cash flow has been very tricky for Alibaba, because I think at least in 2022, everybody was saying that Alibaba was a dying business because the cash flow essentially fell off a cliff. So in terms of the cash flow from 2022, it was at 98 billion renminbi. So 98 billion, I think, was around the 10 to $15 billion range for the whole year, by the way. And a 10 to $15 billion range, if at a $200 billion market cap, that's a 20 times price to free cash flow. And many people like to say, oh, I thought you said Alibaba is cheap. I think 20 times is not cheap. But evidently, because of the spending and the cost structure and how they've been giving out stock-based comp, it has been a very bad picture. But at least in 2023, they have kind of reflected back, or essentially normalized back to where many shareholders are actually expecting it to be, which is around the range of 20 to 25 billion. So at this range now, in $25 billion, you can see at a $20 billion market cap, it's less than 10 times. I think it's around 8 to 9 times price to free cash flow. So if you compare it to many of their counterparts in the US and other listed companies out there, at Alibaba's current size and their influence in the market, I don't know, 8 times, 10 times, it's honestly dirt cheap. So yes, let's assume that you can trust the numbers. Alibaba still remains extremely, extremely attractive with a 1/4 position of their current valuation in cash. And also, they are trading at a price to free cash flow of around 8 times. So if you actually remove out the cash position, then the price to free cash flow is probably nearer to 7 times, give or take. So that's just some general idea. And also this idea of share repurchasing, they've been ramping up share repurchasing. It's at 10.8 billion now, and they still have, I think, 19 billion left in terms of authorization. So since I've talked about share-based compensation, I just wanted to kind of give you some color as well. So you can see the share-based compensation for the year of 2023, they have issued out around 30.8 billion renminbi, while they have bought back around 74.7 billion. So in this case, it's around 40% back. So yes, it's not net accrual, the 10.8 billion. You have to net it out, the 40% in share-based comp. But I think judging from how the pace that they are currently buying back shares, it's still net accrual to shareholders. Many people have been lamenting, oh, why is the management not buying back even more aggressively? I think they are the stewards of our capital. You are investing in the company. Yes, you can continuously make noise on the side. Hey, encourage the management team to buy more. But I guess they are the most in tune with the financial structure, understanding of the long-term view of Alibaba. So you have managed to place your capital with them. Let's just hope that they have the financial incentive, they have the foresight to kind of allocate your capital effectively. So that's some idea. Now, moving on to the two basically disappointment or the disappointing child. So for China core commerce, they did say that there's a mid-single digit decline year on year in terms of the GMV on Taobao and Tmall. These two are essentially the most profitable business of Alibaba. And if there is some sort of slowdown in terms of the Chinese economy or how they are spending money on Taobao and Tmall, it's detrimental to the entire business. I don't care whether Cainiao, Ele.me is growing at like 100% year on year. As long as they are not making money, or at least by day, I mean Taobao and Tmall, as long as they take a hit, Alibaba is going to take a hit. So it's really, really closely related to the entire consumer confidence issue in China. And of course, we did say that, I thought we are hoping for a great rebound in China. I thought many analysts on the side is expecting a great recovery because of this entire winding down of the zero COVID policy. And evidently, we can see that in terms of China retail sales year on year, there's a huge rebound. I mean, this is based on statistics that is garnered. There's a 18.4% rebound. This is in April, so let's not talk about them. So at least in Feb and March, 3.5% and 10.6%. Why is it not reflected? In fact, why is online physical goods GMV actually declining mid-single digit? So that's one. And secondly, if you were to look at the National Bureau of Statistics from China itself, so this is from them, just in March alone, you can see that the year-on-year growth rates of retail sales by consumption type, food service revenue actually rebounded greatly because everybody get to go out and start to enjoy their lives again. But in terms of commodity retail, there is still a very huge recovery and everybody's expecting a good recovery. So why is it not reflected in the biggest, the best e-commerce company, the one with the number one market share? I think there are a few reasons. Number one, definitely it's competition. So in terms of competition-wise, if you do kind of triangulate with other data points, JD hasn't been doing very good on their own as well. So JD, I think, grew like 1% year on year in terms of their core commerce business as well, which is in the same business line as Alibaba. So then many people start wondering, so who exactly is kind of stealing all the market share? And I think one of the main competition or one of the main competitors here is really ByteDance. And sadly, because ByteDance is not a listed company, we don't have additional data points to triangulate. But I think that being said, we let's keep our eyes peeled because it does seem like from Alibaba's management team's call, they are doing a lot on all fronts, trying to do live streaming, trying to nurture more live streamers, and they're investing a lot in terms of user interface, user experience, trying to better their value proposition to both merchants and consumers as well. They're not complacent about it, but I guess competition, you really only know the results of the competition at the end of the day. And just by monitoring these different metrics, it does seem like they have also alluded to the fact that in April, they did recover, rebounded quite strongly. And let's see in the following few quarters how Alibaba is going to perform. So that's the first one on competition. Number two, in terms of the rebounding, in terms of this China reopening. So maybe people like me or analysts on the sites are too optimistic, but I'd just like to think that there are probably still certain frictions around on this entire reopening. Let's not expect that you're locked down for, I don't know, a good 2 to 3 years, and then once it's open, there is no adaptation and how people are thinking to spend. So in terms of the reopening wise, people are also kind of revenge spending, revenge traveling out of China, of course. So the money is flowing out because it's tourist spending, etc. So then when people are focused in doing all those other activities, then companies like Alibaba, because it's an internet company, they might be kind of forgotten for a short period of time. So I don't see this phenomenon as very long. Instead, it's kind of transitory. And number three really is the idea of, because of the quarter itself, they have Chinese New Year and it's the biggest, most grandest event in China. So which also explains these issues. So of course, after hearing until here, you will say that, hey, Chikeng, I think you are kind of blindsided. You are essentially finding excuses. And yes, I think on second thought, it does seem like I'm trying to find excuses, or I'm essentially trying to explain a little bit more, provide more color and appreciation from what the management team is saying. But all I'm trying to say is this. At first, in the last 2 years, when we keep complaining about the tech crackdown and the tech crackdown and the China COVID zero policy, those are very legitimate excuses. But this entire reopening friction, people spending money elsewhere, it's a transitory thing. So this excuse cannot be long-term in nature, or it's not structural in nature. So then you can't really use this excuse in every single quarter's report. So all I'm trying to say is this, especially for long-time Alibaba shareholders like myself, I'm still giving them benefit of doubt. I'm still giving them time to monitor, but I'm actually monitoring it at least for the next 12 to 18 months. I'm still giving them 1 to 1.5 years. And even after 1.5, 2 years, and if they're still reporting this sort of results where CMR is still going downhill, it's just keep going downwards, -3, -5, -8, -10%, then I think there's a certain problem with the business structure. If not, for now, I do believe that there's a lot of friction on the environment itself into affecting how Alibaba is conducting itself as a business and why it's affecting its numbers. So that's one part. Second part, I think many of my discussions is also applicable to cloud. So for cloud, this -2% year-on-year growth rate is a disappointment. I'm not gonna lie. I'm not gonna smoke you saying that, oh, this is a good thing and stuff. Not everything is a good thing. And by being a shareholder, you probably need to be slightly objective. So like I said, the entire idea of this growth rates, this adaptation and this ability to continue growing, you probably might want to give them a little bit more time. But like I said, in the next 12 to 18 months, if they continue to post such disgusting results and not showing any form of improvements, then it's probably a call for concern. And one important fact is I do see some analysts or some YouTubers talking about comparing it to Tencent and Baidu Cloud. I'd just like to point a note here, put a pin here. Only Alibaba actually reflects their results by just talking about Ali Cloud, and it's -2% year-on-year. For both Tencent and Baidu, which is the two other tech juggernauts, they lump their cloud business with some other business segments. So if I'm not wrong, for Tencent, they actually lump it with WeChat Pay, so which they call it financial services, and it's up like 10-12% year-on-year, if I'm not wrong. And it's not really, I guess, it's not really reflective of Tencent Cloud's business. And it's not a one-to-one or apples-to-apples comparison to Ali Cloud. It's different, by the way. So if you lump everything together, maybe the WeChat explosion or the WeChat Pay explosion in terms of the take rate and whatever kind of cover away the growth of Tencent Cloud. So in this case, you can't really compare them saying that, oh, Ali Cloud is down 2% year-on-year and Tencent Cloud is up like 10-12%. It's not a very accurate representation. So let's not do it. And if you want to compare, really just compare on Ali Cloud alone. If you want to look at in terms of market share, you can wait for the market share data to be released. But let's not just jump ahead of this entire discussion and say that, oh, Ali Cloud is losing to the rest. But of course, there's one more very important player out of this entire cloud mix, which is China Mobile. I'm keeping a close eye. I'm probably going to release a new video on China Mobile soon because their cloud is really creating havoc in the entire space, especially when you would think that tech companies would win the cloud market, but then you have this state-owned enterprise winning. So that's just look forward to that video and subscribe if you want to look at that video. So firstly, I just wanted to focus on the strategic updates for China commerce. I didn't pull whatever I said out of my ass. It's guided by management. So they did say that in the month of March, online physical goods GMV growth on Taobao and Tmall, excluding unpaid orders, turned positive, driven by strong growth of fashion and accessories and healthcare categories. And I'll presume that this trend will continue strongly in April through June and stuff like that. So that's one part. And on the second point that I wanted you guys to take note is really the idea of business group spin-offs. So we know that Alibaba's management team have been talking about unlocking shareholders' value. So in this case, they did provide some sort of concrete guidance already. So they did say that they're going to IPO Cloud Intelligence Group, which is Ali Cloud, and this spin-off will be subjected to the restructuring. But at the end of the day, they intend to structure the spin-off in the most tax-efficient way, and they are probably going to give stock dividend. So we are looking forward to Ali Cloud spinning out as an individual company that's going to be listed in the Hong Kong Exchange. And current Alibaba shareholders is going to get the dividend in terms of the Ali Cloud position itself. And then there are two other considerations, which is the IPO of Cainiao and the IPO of Fresh Hippo, which is their retail business. So I think Of course, this is a little bit too much, and I do understand that this video is getting slightly lengthy. I'm just gonna say generally whether I think it's a good thing or bad thing. So I remain relatively neutral in terms of this IPO and this spin-off, because I think that there are both pros and cons on both sides, whether to keep it as a company and to spin it off to unlock shareholders' value. This topic alone deserves a separate video. So I also want to plant my flag here and promise you that there's a separate video on this idea of this new spinning out of Ali Cloud, IPOing Cainiao, whether it's a good or bad thing for shareholders. But for now, at least my own opinion, or at least my own uneducated guess, I'm still neutral about it. Whether they spin it out or not, it doesn't matter, because a pizza, you cut it by how many times, theoretically it doesn't matter. But in terms of a financial engineering point of view, it might benefit shareholder. And last but not least, I really just wanted to kind of go back to this table and to kind of show you the valuations of Alibaba today, to really just give you a taste on how the market is valuing them, and not talking or notwithstanding the idea of unlocking shareholders' value. So this is Alibaba's current price. It's at $82. This is Alibaba's current market cap, around 220 billion. Their net cash position is 58 billion. Total short-term and long-term debt, 22 billion. So their enterprise value, if you less cash, and then you add the debt to really understand the capital structure, to take into account the capital structure of the business, it's around 184 billion. So the 2023 EBITDA is 25 billion and 2023 free cash flow is 25 billion. So in this case, their EV to EBITDA now is 7 times. The EV to free cash flow 7 times, price to free cash flow 8 times, their free cash flow yield is 11.4%, their PE is 21 times and their forward PE is 9 times. And they did say that they're authorized to buy back around 19.4 billion worth of the company. So let's assume that it's 20 billion. So let's say that Alibaba's market cap is at 200 billion now. This is the statistics, or this is the multiples that you're looking at. A 12.5% free cash flow yield. And then you reflect it back to some of your most promising tech companies out there in the US. They probably have a free cash flow yield of around 2 to 3%. Even though that the government long-term yield is, I don't know, at 3-4% now, and the Fed funds rate is at 5%. So even if you were to conservatively say that the free cash flow yield is, because of the China discount, you want to put it at, I don't know, 5%, 6%, 7%, it's 2 times or 3 times of your US counterparts. And it's at a Fed funds rate kind of level. Then yeah, Alibaba probably still have room to kind of double, to kind of reach its fair price. And evidently, based on this very rudimentary, very rough, very unrefined kind of calculation, back of the envelope, just using multiples, I think Alibaba is clearly easily double of today's pricing. And at least my fair value calculations is around 150 to 160. I mean, that's just my general idea and thoughts of Alibaba's valuation today. So do feel free to leave in the comment section down below whether you think Alibaba is still a buy or not. And for those of you who are extremely hateful, you don't like about the China discount, you're scared of Chairman Xi, then I think this video is really not for you. This investment vehicle is not for you. But I think for those of you who are still holding on, I'm actually quite interested into understanding why you're still holding on to it. So with that, I'll see you in the next video, but more importantly, I'll finally see you on the moon. Goodbye!